Imagine waking up one morning and realizing that your savings are worth half of what they were yesterday. Banks freeze withdrawals, currencies lose value, markets crash without warning, and suddenly everything you thought was safe isn't. But here's the truth most people never learn. Throughout every economic crisis in history, from inflation spirals to full-blown market collapses, a small group of investments consistently survive. Today, you're going to learn exactly which investments have outlasted every major financial disaster, and why understanding them right now might be the difference between preserving your wealth or watching it disappear. In a world where financial markets rise and fall faster than most people can keep track of, one uncomfortable truth keeps resurfacing. Not all investments are built to survive. Economies shift, political tensions rise, currencies lose value, and entire asset classes vanish the moment a crisis hits. But despite all the chaos, history has repeatedly shown that a small group of investments consistently survive the test of time. Today, we're diving deep into that idea, into what it means to protect your wealth when everything else around you feels unstable, unpredictable, and volatile. This video is inspired by the analytical rigor practiced by some of the most disciplined investors in history. Rather than focusing on hype, trends, or emotional decisions, we're looking at the data-driven truth, the patterns that keep repeating themselves through every major economic collapse. Whether it was inflation spirals, global recessions, debt crises, or currency failures, these patterns reveal 4 categories of investments that demonstrate extraordinary resilience. So in the next 10 minutes, we'll explore these 4 survivors, why they matter, how they behave under stress, why they stay valuable when others crash, and what lessons every day investors can take from them. This isn't financial advice, this is deeper. This is about understanding the structural forces that shape financial survival. To understand why certain investments are able to survive catastrophic downturns, we first have to recognize the environment we're living in today. Over the last decade, global debt has reached record-breaking levels. Countries are borrowing more than ever. Households are overstretched. Corporations rely heavily on credit just to operate. Central banks are constantly forced to choose between inflation, deflation, or recession, each one a potential spiral. When interest rates rise, it pressures governments, businesses, and ordinary individuals. When interest rates fall, it encourages reckless borrowing and sharpens the risk of inflation. Either way, the global financial system has become extremely sensitive. It only takes a slight shock, an unexpected crisis, a geopolitical conflict, or a sudden market correction to trigger a chain reaction. That's why long-term resilience is no longer a luxury. It's a necessity. Investors can no longer rely solely on high-growth stocks, speculative technologies, or risky assets that collapse when fear rises. And here's the deeper truth. Economic cycles are becoming shorter, more unpredictable, and more interconnected. Problems spread faster, markets react instantly, and the room for error grows smaller each year. This is the backdrop behind the 4 investments we're about to explore. These are not get-rich-quick ideas. They are instruments of protection designed to retain value when the world swings into uncertainty. They survived past crises not because they're magical, but because they are fundamentally rooted in real value, scarcity, stability, or necessity. And in hostile financial environments, those qualities become priceless. The first investment that consistently survives financial collapse is the one humanity has trusted for thousands of years. Stores of value with historical memory. These assets, such as precious metals, retain purchasing power even when currencies collapse. They are not dependent on governments, not controlled by central banks, and not at the mercy of inflation. What makes these assets unique is that they behave differently from modern financial instruments. Stocks depend on earnings, bonds depend on interest rates, currencies depend on political stability. But stores of value depend on something deeper, universal: acceptance. Across continents, across generations, and across cultures, they have been recognized as reliable forms of wealth. During periods of hyperinflation, wars, political collapse, or economic restructuring, these assets often rise because people flee from unstable currencies into something tangible. They are not designed to generate cash flow. They are designed to protect. In every major crisis of the last century, large-scale depressions, currency devaluations, sovereign defaults, we see the same story. When confidence in the system collapses, people rush to stores of value. And when confidence returns, these assets still retain most of their worth. That combination of stability and universal acceptance is what makes this category a survivor. The second survivor is the complete opposite of the first, ultra-safe, highly liquid financial instruments issued by stable governments. These investments do not offer high returns, and they are not glamorous. Yet, when markets panic, they suddenly become the most sought-after assets in the world. The reason is simple. In times of crises, capital seeks safety. It doesn't seek excitement. It doesn't chase high returns. It seeks preservation. Instruments such as treasury bills, government notes, and equivalent. Sovereign-backed debt tend to perform exceptionally well because they represent stability when private markets become chaotic. But the real power of these assets lies in liquidity. During market crashes, one of the biggest dangers is being stuck. Investors holding speculative assets often cannot sell them without catastrophic losses. Safe haven debt, on the other hand, is always in demand. You can exit quickly. You can rebalance instantly. You can survive the storm, even during historic market crashes. These safe instruments often gain value because large institutions, corporations, and international investors flood into them as a defensive move. This is why they are considered defensive anchors in a portfolio. The third resilient investment category is made up of companies that generate reliable, consistent income regardless of economic cycles. These are not speculative growth companies. They're not dependent on hype, innovation waves, or unpredictable trends. Instead, they generate cash flow from everyday demands utilities, essential services, consumer staples, and profitable, well-managed businesses with a long record of paying dividends. What sets these companies apart is their stability. During market downturns, their prices may fall temporarily, but their business models remain intact. People still need electricity. People still buy food. People still use essential services. And when a company can consistently pay dividends, even during recessions, it signals strong financial health. Over decades, dividend-producing companies tend to outperform the market not because they skyrocket during good times, but because they remain steady during bad times. Their cash flow provides a cushion that many speculative companies simply do not have. Investors who prioritize survival over excitement understand the power of steady income. When markets fall 40%, these companies do not collapse. When inflation rises, these companies adjust. Their resilience is not theoretical lit, is proven through multiple economic cycles. The fourth survivor is one of the oldest wealth-preserving investments, real, tangible assets rooted in the physical world. Real estate, farmland, and essential infrastructure fall into this category. What makes them powerful is not just their value, but their utility. Land can produce food. Buildings can produce rent. Infrastructure can generate fees. These assets do not disappear when markets crash. They do not go to zero. They are tied to human necessity. Throughout history, people have always needed shelter, space, and resources. That demand doesn't vanish even during recessions or crises. If anything, it becomes stronger. Real assets also have another advantage. They often rise with inflation. When prices increase, the value of land, property, and essential resources typically rises as well. This gives them a unique role as inflation, resilient holdings. In many countries that have experienced currency collapses, real assets became the primary form of wealth that survived the disaster. They provided income, stability, and protection when everything else failed. So when we talk about surviving the next crisis, whatever form it takes, we're not talking about chasing trends or predicting the future. We're talking about understanding force, resilience, and historical consistency. The four categories we explored today have survived world wars, recessions, inflation waves, political collapses, and currency failures. They are not perfect, they are not magic, but they are durable. And in a world filled with uncertainty, durability is the most valuable asset you can own.